In continuation with the previous question of PE multiples, so for our benefit of our viewers, for selecting a stock, whether PE multiples is the only barometer or is there any other barometers, maybe ROCE, ROE, price to book value, because we hear a lot, we read a lot, people go to media, CNBC here and there, lot of data comes out, right? What are all the other parameters that you use to select a particular sector and few stocks under that particular sector for your mutual fund portfolios?
We look at multiple valuation metrics when we are deciding on a particular stock. The usual ones, as you rightly mentioned, are price to earnings multiple,
Correct.
Price to book value, or enterprise value to EBITDA, or sometimes if the assets are really looking cheap, then you may compare it with the replacement value as well. Because the industry may not be doing well at a particular point of time, but if the replacement value is much higher than where the stock prices are indicating, that gives an opportunity. So, and sometimes the acquisitions that happen in the particular industry segment can also become a barometer. We also look at discounted cash flow and see what is the likely cash flows over a period of time from the business, and then we discount that back to the current level, today's level, and see what is the net present value. And if there is a deviation between net present value and where the stock is available today, that can also be a way of looking at how to invest and where to invest. So multiple valuation models we generally tend to look at, and it's not a single factor that will decide your a positive opinion or a negative opinion on a particular business and its valuation. It could be combination of factors.
So it is a full-time job. So how it works? You have a research team, analyst team, fund management, because I deal with more than 2,500 active customers across locations, more of retail, just for their benefit. How this whole matrix works, how many people are there in research, how they report to each other, how you arrive to select a particular stock or to remove from your portfolio. Little light on that, is it possible?
Sure. So we have a very large and experienced research team. It's a 17-member research team, including the analysts who cover ESG analysis. So this research team is very experienced. The average experience here will be more than a decade, and many of them have put close to 15 to 20 years with Kotak itself. So it's a very experienced team.
Nice to hear that,
So this is the team which keeps analyzing the businesses, keeps analyzing the valuations which are there in the market today, whether those valuations are reasonable, whether it makes sense to invest now and hold it for a longer period of time so that you benefit from that. So they keep doing this analysis on a regular basis. So in all, we cover more than 500 stocks in the research universe. So this is essentially the investment universe that is available for portfolio managers.
500 stocks.
500 stocks. On all 500 stocks, on a regular basis, our research team interacts with the management, interacts with competitors, interacts with the entire supply chain or the vendor chain. They do the entire analysis of the business, the management which is running that business, and also the valuations. And then they recommend to us whether it's a positive opinion or a negative opinion. And they also prepare a model portfolio, which is purely a paper portfolio, but it gives you the pecking order of research in terms of what they like, what they don't like. So that becomes the basis for the fund management team. Fund management team obviously looks at all the stocks where there is a positive opinion from the research, and also looks at the model portfolio, and then tries to construct each portfolio based on the mandate that is
that fund carries.
The fund has been given. So that's broadly how we carry out the work. And there is a continuous monitoring as well, both at the research level in terms of monitoring the businesses, and also at the portfolio level where we keep monitoring the performance of the portfolio, the risk of the portfolio, all of that.
So this 500 stocks, whatever you have mentioned, it varies. It is from almost all the sectors.
Yes, it covers almost all the sectors and covers almost 90% of our total market cap. So in a way,
90% of the market cap is with 500 stocks.
Yes. This is essentially where an institutional investor would be looking to invest. So most of these companies are covered, and also as new IPOs come, if there is an interest in those IPOs, then we analyze those IPOs and bring it under our coverage. So the coverage generally has been growing over a period of time.
Okay. And these 500 stocks, what you have mentioned, now take an example, the present scenario. Your FMCG is not doing well for last few years. IT was not doing well. Slowly it has come back. Same is pharma, if I am not wrong. So this sectoral part and stock specific part, this both work happens at research level first, then you will build model portfolio.
The research analysts are given sectoral responsibilities.
Okay.
So let's say there is a sector, automobile sector. An analyst covers all the companies under that sector.
All the stocks.
He is an expert on that sector. So that's how we have segregated responsibilities of our research team.
Okay.
So depending on the complexity of the sector and how many businesses are there to evaluate, we have divided the responsibilities, and they keep giving inputs on those sectors and the businesses within those sectors. That's how it works.
Okay. In case, say, just a little different question. In case you have done all your filters properly, everything was tick marked with green. For some reason, something happens in that organization. You will quickly, you will just evaluate and you will quickly remove that, or you will hold on to that stock or idea for some more time, or how exactly it happens?
It depends on what is that development. Whether that, assuming that it's a negative development by the question that you asked me.
Correct.
If it's a negative development, then we need to see what is the impact that it is likely to pose to the business itself from a short term and a medium term and a long term perspective. What is the current market price telling you? If it is an impact of, let's say, hypothetically, a 5% impact, and the stock has already opened 5% below, there is no way to panic again. There is no point in removing the stock. So we need to again re-evaluate at every point of time.
It is highly dynamic.
Highly dynamic. What we have done yesterday may not be relevant today. We need to look at tomorrow and then take a decision, right? So every time it is about the future expectations and what is currently in the price, whether it makes sense to add, reduce or hold the position. That's how. And sometimes it may not be a negative development in a particular stock. It could also be that relatively there is a better opportunity, or there is a relatively better stock based on the lower risk that can come into the portfolio. Even if you are expecting similar kind of upside, but let's assume that one particular stock gives you the same expected returns at a lesser risk, you may want to put that in the portfolio. So it's always a dynamic assessment of what is there in the portfolio, what can likely come into the portfolio. All of those decisions have to be considered.
So when we are just saying market went up this much, tomorrow we will see NAV went up this much, it is not, many times it may be directly proportion, but definitely there's a lot of work happening at the back end, which generally we don't observe.
Yes, and even when no decision is taken, that itself is a decision, right? Because there is some analysis that's been done and we have decided not to change the portfolio. That is also a decision.
Correct.
So it's not that every time you need to buy or sell to actually make a decision. Holding to particular portfolio is also a decision.
Okay. Thank you. This is a good information.